So how are we actually going to generate money out of the currencies market, right? Because this is the objective of the course. Learn about the foreign exchange market in order to be able to generate money out of it. So in the lectures that we've went over on the history of money, we understand now that each country has its own currency, right? I live in Canada, so when I go to pay for something, I use Canadian money, Canadian dollar bills. So this is a $20 Canadian bill. But when I went on vacation to Mexico, I couldn't pay for stuff with this bill. I had to use pesos, right? So I had to convert some of my Canadian money to pesos in order to buy stuff there. Now the rate is not constant, like we've saw from the previous lectures, because each currency isn't backing up their currency by gold, and then you could say, well, if this is worth this much gold and this is worth this much gold, then this is worth this amount of that. They're just floating. Okay, so it's based on supply and demand. So how many dollars would give me how many pesos? Well, it depends on the rate. So let's say this. Let's say you're going on vacation. Let's say I'm going on vacation. Okay, and I'm going from, I live in Canada, but let's say for simplicity, let's say you're living in the US. And the rate right now from US to pesos, okay, and let's just write it like this. If you want to bring $1 US and convert it to pesos, $1 US would give you 20 pesos. Okay, this is the current rate. So you have, you're going on vacation, you're like, okay, well, you know what? I'm going to bring $100. Okay, let's say it's a short trip. You bring $100. Well, you go to the exchange place, you could go to the airport or wherever, and they exchange $100 and you get 2,000 pesos. Now, you stay there for a week. And let's say when you go there, you ended up not spending any money. Your friends paid for everything. You have really cool friends. You didn't spend anything. So you come back to the States and then you're like, well, I have all these pesos here. What am I going to do with them? Right? What am I going to do with these 2,000? I want to convert them back to US. Well, the currency rate, the exchange rate might have changed, right? It could be something different now. So let's say that when you're coming back, the exchange rate changed, and now the new rate is $1 US will only give you 16 pesos. That's the new rate. Right? So this would mean that pesos actually gained in value. So $1 US can't get you as much pesos as before because pesos are more expensive. So, it takes time to understand this. So if $1 US gets you less of something, that means that that other thing became stronger. It gained in value. Okay. So how many US dollars are you going to be able to get back with your 200 pesos? Well, you have those pesos that are more valuable now. So you'll probably be able to get more US dollars. So what you would do is, well, 2,000 divided by 16, right? So I'll open a calculator here. You get 2,000 divided by 16, because each 16 pesos are going to give you $1. That gives you $125. So you go back to the airport and you go see the exchange shop and you convert it back, and now you get 125 US dollars, making in profit, right, $25. Because you had 100 initially, but now you ended up having 125 bucks. So you made $25 because of that exchange rate fluctuation. Now, if the exchange rate changed differently, meaning the pesos, $1 US could bring you, 30 pesos, well, you would have lost money because pesos wouldn't have been worth as much anymore. Okay? Now, are you really gonna do this to make money? Are you gonna go on vacation and not spend money? No. You can just convert the money, keep it. If you had some analysis that told you, you know what, I think the peso is gonna strengthen, so I want to hold pesos right now because in relation to the US dollars, it's gonna strengthen. So I'm gonna hold it and then I'm gonna convert it back. You could have made money like that without even going on vacation. But you don't want to go to the exchange shop and exchange money because there's fees and stuff like that, and there's time. You can open an account with a broker, which we're gonna do all of that, and do it from home. Do it from your cell phone. It takes seconds, right? And this is what we're gonna be doing. We're gonna be speculating on the exchange rates and try to generate money out of it. Now, what is the actual exchange rate between US and pesos? You can actually just Google it. US to pesos. And here, so $1 is 18.77 Mexican pesos right now. So if you change it right now, it would be for that amount. Now it changes all the time, every minute. It's different, right? But we'll look into that in the next lectures. So I gave an example about converting US dollars to Mexican pesos. And I said it was $1 to 20 pesos. Well, what is that? How do we talk about this? When you talk about a currency in relation to another currency, we call this a currency pair. So you'll often hear this term, what currency pair are you trading? Which pair are you looking at? So a currency pair is just quoting one currency against another. So USD to Mexican pesos, or any combination of currencies. Now, in this currency pair, there's two currencies. You have the base currency and the quote currency. The first one is going to be your base currency. And the second one is going to be your quote currency. So if, let's say for the previous example that we had, and I said USD, let's see here, USD to Mexican pesos, okay? Well, we would have said that this here, the USD, this is what we would call our base currency. Okay? It's our base currency. And the Mexican pesos is our quote currency. Okay? So this would be the base currency and this would be the quote currency. Okay? Because you're saying the base currency is always one, right? So you're saying $1, how much can that give me in Mexican pesos? So the first one, the base currency, is the one we're relating to, saying, well, how much one of this is going to be worth in the other one. And the other one, the second one, the quote currency, is the one we're quoting. So we're giving a quote on it. We're saying, well, we're quoting a price of $20, 20 pesos for this $1. Or we're quoting at 18 pesos 0.7 for $1. Okay, so this is the base currency, quote currency. Now, the way we write these currencies, why didn't we just write US? Or why didn't we just write peso? Why did we write this? Because each currency is identified by its ISO currency code. ISO stands for International Organization for Standardization. And basically, if I open it here, okay, so you'll see that for each country in the world, you have a code, right? The ISO code. And this code is 3 letters. And let's say if I go to Canada, and it's just a standard, so everybody can understand each other. For Canada, the code is CAD, so CAD, and it tells you here Canadian dollar. If you want to go, I don't know, China, CNY, yuan, right? Yuan, renminbi, those just call it yuan. So you have for each country. So if you don't know what the code is for the country you want to trade, just go on this list and you'll find it. If you want to go to the United States, you have USD, US dollar, okay? And don't bother with these, don't need to look at those. And yeah, so you have all these countries here, and you can just Google ISO code and you'll get to a bunch of different websites that have the same codes. Now, let's just go back to pound it in just a bit more. So if you have a currency pair of, let's say, USD CAD, and the price is 1.35, you would say that the base currency is USD, quote currency is Canadian, and so this is the quote for the USD against Canadian dollar. The quotation of 1.35 means that $1 can be exchanged for 1.35 Canadian dollars. So keep this handy if you always get confused. But by the end of this course, this for you is going to be something very simple. So not all currencies are equal. And when I say they're not equal, I'm talking about trading liquidity. So not all currencies are traded as much as one another, right? And you probably know that the currency that is the most traded is the US dollar. And it's actually the most traded when you compare it to other currencies. The second most traded one is the euro, and the US dollar is traded 3 times more than that around. So it's very, very liquid. Now, the countries or the currencies that are most traded, we call the major currencies. And this is the list of the major currencies here. Now, I didn't put them in order. It is true that the US dollar is the most traded one. The euro is the second, but I didn't really put these one in order. They might be, they might not be. But yeah, you have the Japanese yen, that's very much traded as well. The British pound, Australian dollar, Canadian dollar, and Swiss franc. So these are the major currencies. Now, because of that, we have what we call the major currency pairs, right? And these are just pairs that are very, very liquid. So very widely traded. So you're not gonna find pesos to, I don't know, Japanese yen. It's not traded as much as these ones, okay? Or even pesos to something else, a country that's not even a major. So you have the pound sterling to USD, which some of these have like nicknames. So we call this one the cable, but you don't really need to learn those. You have USD CAD, people call it the loonie. The Australian to USD, we call it the Aussie, so Australian dollar. Then this is USD to Swiss franc, so people call it the Swissy. USD to Japanese yen, Euro to USD, and New Zealand dollar to USD. So these are the major currency pairs. You'll see these often, and you're probably going to start by trading one of these currencies, okay? Now, you might be wondering, why do they have USD CAD and not CAD USD? Or why do they have here USD first, and then here you have USD second? Like, can you trade them, USD to Euro or Euro to USD? Well, there's a convention, and the convention goes as this. And, this is outside of course material, but it's just for your general information. Why do they do that? They have like a rule, and the rule is like, if there's a euro in the pair, the euro is going to go first, okay? But then second, the pound sterling. So if there's a euro and pound sterling, then the euro will go first, pound sterling goes second. But if there's no euro, then the pound sterling is going to go first, okay? So here. If there's not that, Australian dollar goes first. If not that, New Zealand dollar. If not that, US dollar, Canadian dollar, Swiss franc, Japanese yen. So this is like the rule that they have of which currency goes first. And this is, sometimes people, wonder, why is it like that? This is their convention. Now, for the other currencies, so let's say pesos or any other currency, which we call the minors, they're generally quoted against the USD, right? So you're going to see them next to the USD. That's how most people are going to trade them. Now, if you're not trading them against the USD, what we're going to call this pair is, we're going to call it a cross pair, okay? So a cross pair is any pair that does not include the USD. So let's say, even if I'm looking at CAD, Japanese yen, okay? So now you know what currency pairs are, cross pairs, major pairs, and we're ready to move on to the next lecture. So now that you know what currency pairs are, what are you going to do if you want to exchange a currency or buy or sell a currency versus another currency? We've already came to the conclusion that you're not going to go to the airport to exchange your currency there. You're not going to go to one of those foreign exchange shops. You're going to do it from home. Well, how are you going to do that? To know how you're going to do that, you need to understand the market structure in the foreign exchange world. The thing with FX is that it's a OTC market. What is a OTC market? An OTC market is a over-the-counter market, meaning that there's no central exchange where you go to transact on. It's not like the stock market, where if you want to buy a particular stock, it's listed on only one exchange, like let's say NASDAQ or New York. You have to go to that exchange to buy or sell that stock. In the FX world, it's not like that. If you want to buy US dollars, you don't have to go to the Fed's office to buy US dollars. You can do it anywhere with anyone. So it's over the counter. And because it's over the counter, execution prices will vary, right? This is a big thing. So if you want to buy some pesos, well, if you go to the airport, they might give you a really bad rate because they know you need it. If you go and you exchange it there in somewhere very touristic-y, it's going to be, more expensive. But if before that, like before I went to Mexico, I called a few shops here in Montreal and I started negotiating the prices. They told me, we're giving it to you for $14. And so I called somebody else. They said $14.20. I'm like, well, somebody else, I lied. Somebody else told me $14.30. Can you give me more? Okay, we'll match it. Okay, I'll take it. So, you can negotiate if you're doing something like that. But if you're trading online, the rates are going to be very thin. You can't call and negotiate. But depending on where you're buying from, you might have better rates, right? So it's important to know that the rates are not going to be the same everywhere. Now, the actual structure is like this. You have the interbank market, and the interbank market is where the huge banks transact with one another, okay? Now, these huge banks, they can transact through EBS, which is the electronic brokering services, or Thomson Reuters. These are the two options. They basically provide a order book for all the huge banks, okay? And when I'm talking about huge banks, I'm talking about Deutsche Bank, UBS, Citigroup, Barclays Capital, RBS, Goldman Sachs, HSBC, Bank of America, JP Morgan, Credit Suisse, Morgan Stanley. The huge banks. These banks account for approximately, I think, somewhere between 60 to 70% of all the volume, of all the transactions that happen in the FX world, okay? So they have this order book where they can transact directly with one another, okay? Now, this is only available for huge banks. You cannot go and trade there. It's billions and billions of dollars every second, it's huge amounts of money, okay? So where do you come in? So this is the players, right? And the huge banks that I talked about, this is what we call the FX dealers. They're on the top. Now, other participants can't just go and trade with them. They can't go and get on this order book and say, I'm going to buy at this price, I'm going to sell, because they're too small, right? They're not going to accept them. If you want to trade, you have to go through one of them, okay? So the second level here is other big participants, and these could include other banks, right? So local banks that you know of, large companies, hedge funds, very big participants, okay? And these guys would go through one of them. They can go through, let's say, HSBC, or they can go through JP Morgan. They can go through one of these dealers. Now, where are you? You're still not at this level, because this is still huge money, okay? Now, there's another level here, and this is the level you're gonna go through. You have Forex brokers and retail ECNs. We can just call this brokers, okay? And I'm gonna talk more about brokers in general in the next section, or in a few sections maybe. But these are gonna be people who take care of getting an execution for you, right? So you have to go through them. So a broker here is gonna be going through one of these banks, which this bank is going to be going through one of these FX dealers, okay? So like there's a few steps here. And you have to open an account with one of these brokers. It's like when you buy a house, you get a broker, and the broker is responsible to get you the house that you want. Same thing in Forex. Or in stocks, you want to buy a stock. You open an account with a broker, and the broker, you give him your order, what you want to buy, and he tries to get you executed on that. Same thing, you want to buy, pesos. You want to trade that. Well, you open an account with one of those brokers and you send your order. Now, what the broker is going to do, there's a bunch of different types of brokers, which we'll talk about later. He'll either take your order, batch it with other traders, and because otherwise you guys are too small, right? And send it over as a larger order. so it gets accepted. He has a deal with one of these other banks, and this other bank gets it executed, and you get your fill. Now, some other brokers take the trade against you. So you want to buy it, they'll sell it to you right away, right? But then as soon as they sell it to you, they might hedge their order by buying it from another bigger bank, and they're gonna have their own rules. They might be able to hold some risk. They might only hedge their risk if they have exposure to one currency way too much. But what you need to know is that basically you're gonna have to open an account with a broker, and your level is like way down there, right? So you're going through multiple people to get your execution. We'll talk more about brokers later, so you know which broker you should open an account with, because they don't all have your interest in mind. Some of them just want to make money off of you, and that's it. But we'll talk about that later. But this is really the structure, and now you know where you are within it. So it's time to get into the terminology here, because to be moving forward, we're going to be using some, I guess, trading jargon or Forex terminology. So you need to know it for us to, advance and look at brokers and look at charting and all of that nice stuff. Okay, so these are some words we're going to be using often. So spot price. What is the spot price? Or you might hear, this is just the current price of a currency pair, right? So when I went on Google earlier, or if I go on a charting software and you see the price, this is the spot price. This is the current price, the last executed trade, right? The last transaction that happened on that broker is going to be the spot price there, okay? So then we have the order book, the bid price, the ask price, and the spread. And I think the best way to explain this here is through a little example. So the order book, okay, is going to be basically, I'll put it here, order book, okay? This is going to be the book with all the buyers and all the sellers. So let's say you want to buy, and let's keep with the USD to Mexican peso example. Well, you'll have the buyers, so people who want to buy Mexican pesos with USD. So let's say somebody wants to buy, at 20 pesos per US dollar, okay? Well, somebody else wants to buy at 19. Maybe somebody else wants at 18.50, right? There's a bunch of buyers. And this is the price. There's gonna be a quantity too as well, but let's just assume there's just the price for now. And then you have sellers as well, right? And sellers, somebody might want to sell at 21. Somebody else might want to sell at 21.50. Somebody else might want at 21.99. Somebody else at 25. So here you have the buyers, and here you have the sellers. Okay, so we have buyers and sellers. Now, what we're gonna call this is the order book, because it has all the orders for all the people who want to buy and sell. These are open orders. Now, if somebody comes in and says, well, I want to buy Mexican pesos at 21, and somebody is willing to sell them at 21, this order is going to be removed as long as they have the same quantity, and it's going to come off the order book, okay? And it will just show up as a transaction that happened, okay? But as long as somebody is waiting and wants to get filled or wants to get executed, they want to place that trade, have that execution, but it's still not executed, it's part of the order book. Right? And when I talked earlier about the big banks going through Thomson Reuters, well, they have an order book and they see who wants to buy how much at all these levels. Now, in the order book, the best buyer here, or the buyer who's willing to pay the most, we call this the bid. Okay? And here, the seller who's willing to sell at the lowest amount of price, we call this the ask. So the bid here, and if I put this back here, the bid price, okay, is the buyer who's willing to pay the most. Now, if you want to sell right now this moment, what price can you sell at? You can sell to the guy who's willing to pay the most, right? So when you're looking at the bid price, you can think of it as, you know, if I want to sell right now, I can sell at the bid price. Now, the other way, if you want to buy right now, where can you buy? You're not going to put your order, if you want to buy, we'll go back here. You're not going to put your order here and be like, I want to buy here, because then you're just going to have to wait until somebody sells to you. It's not how, so if you want to buy right now, you're going to have to buy at the ask, okay? And the difference here between the bid and ask, we call this the spread. Okay, the spread. The spread is going to be the difference between the bid and the ask. And the spread is kind of like your commission, the cost. Okay, because let's say right now you want to pay, you want to buy this currency, and you buy it at 21. Okay, so you buy at 21, and then right away you turn around and you sell it at 20. So you just lost $1, right? A peso. So you just lost that. So you buy it at 20 and then you sell it. So let's put it here. So you buy at 21 and you sell it at 20. So you lost the spread. So the spread is your commission. Okay? So you want something that has a low spread, right? If, let's say, in this case, you lost $1. But if the prices were different here, if let's say here the ask was, let's say, 20.50 and the bid was, let's say, 20.40, well, if you would have bought at 20.50, okay, at 20.50 and then sold right away at 20.40, you would have only lost 10 cents. Okay, so you want to make sure that when you're trading something, you have a small spread. Now, this order book, most of the time, you're not even going to see it. You're not going to see all of these things, and you're only going to be provided the bid and ask. And with a lot of brokers, they won't permit you to place your order in the order book and transact with other clients, right? Some of them would, but others will just give you those prices, and they're gonna be trading against you. So, oh, you want to buy? Well, they'll sell it to you at that price, and they'll handle in the background getting it or doing whatever. Okay, but then they might have a different spread depending on the time and the volatility of the market, because you know, if they can get this currency at, let's say, 20.48, okay, and they'll sell it to you for a higher price, they'll do that. Okay. But then the problem is if they give it to you at 20.48 and then by the time they get it, or at 20.50, sorry, and by the time they get it, the price really moved, there's risk. So they might widen their spread when the market is moving a lot, okay? And we're gonna get into that when we talk about brokers, but this is something that you wanna, you know, keep in mind. This is the terminology for, spot price, order book, bid price, ask price, and the spread. The next words you want to get familiar with is pips. So you have point, pip, and pipette. So we'll start with pip. A pip is a change in a currency by 0.0001. Okay? So it's the fourth decimal place here. So when you're looking at currencies, I'm going to pull up a chart here. We're going to go over charting later, so I'm not going to explain any of it here. But you'll see that something like this, let's say I'll go USD CAD. Okay? You'll see something like this here. The last executed trade is at 1.33916. It's not just $1.33. We're going more than that. We're being very precise because you can buy something at a very precise point. You're not going to buy something USD CAD at $1.33 and then wait until it goes to $1.40 because currencies don't move as much. You'll see that this is, well, this is a daily chart, but we'll go into that later. Currencies move often just a few cents, less than that. Sometimes they stay within, a 1 cent range for months, okay? So what you're trading is sometimes smaller movements. So we go into several decimal places. So you'll see here, even when you're looking at the last price, that you have the USD CAD at 1.3391. So this one here is a pip. So if it goes from 1.3391 to 1.3392, then it went up by 1 pip. If it goes from 1.3391 down to 1.3381, then it went down by 10 pips, right? Because this one here is a 1 pip. Here, let's say, if this goes up from 0.6685 to 0.6687, then it went up by 2 pips, so from 5 to 7. So this is a pip, okay? Now, we became so precise now that we've actually also added something else. We've added a pipette, which is 5 decimal places down, so 0.00001, so even more precise. So you'll see here, this small 6 here, that's a pipette, right? So if this currency goes from 1.33916 to 33918, then it went up by 2 pipettes, right? Usually we're going to be talking in terms of pips, right? So this is going to be the thing that you're going to hear most often, and there's lots of reason for that. Even when you're calculating how much position you're buying or profits and losses, we're always going to be talking in pips. Hey, I'm buying this and I'm trying to make 50 pips on it. I'm trying to make 40 pips, and in your head, we'll do the math later, that if you make 50 pips, you'll make this amount of dollars, or you'll make this amount of dollars. You'll also know how much money you're making per pip. So if it moves up 10 pips, you're making 10 more times the money that you've calculated. And then a point is just the minimum change. So for different currencies, most of them now are going to be in pipettes, so the minimum change is going to be in pipettes, but we call that a point. But the one that you really want to remember is pip. Next word to get familiar with is lots. So a lot is the standard measure of units, okay, when you're trading currencies. And a lot, which is a standard lot, okay? But whenever we're talking about a lot, we're talking about the standard lots. A standard lot, so when you're buying one lot, you're buying 100,000 units of the base currency. So if I'm looking at USD CAD, well, here, USD CAD that we just looked at, what this means is I want to buy $100,000 of this currency, but I want to pay 100,000 US dollars. Okay, I'm putting in 100,000 US dollars. Now, how much will it cost me in Canadian is going to be more, because a Canadian dollar is 1.33 for each 1 US dollar. So it'll cost me 133,000 Canadian dollars. But remember, we're always talking a lot is in the base currency. We're putting that amount of money in. So if you're buying any currency, we're saying one lot, meaning you're going to buy for an amount worth $100,000 of the base currency. Now, you might say, wait, I don't have $100,000 to trade with. How come one single lot is $100,000? Well, don't worry about it. I'm not expecting you to have $100,000 to trade with, or anything near to that, especially if you're starting off. You want to start off with a very small amount of money, or even just paper trading, which we'll talk about later. But your broker is going to be lending you a lot of the money that you're going to be trading with. So nobody trades Forex with their capital. They borrow money from their broker to trade. And the reason for that is that currencies move by small amounts, right? So if we talk again about, let's say, USD CAD, well, if you have $100, let's say, and you buy USD CAD, and there's a move that happens, and it goes from $1.33 to $1.34, which a cent move is a big move in currencies. Well, how much are you gonna make? You're gonna make $1, and that's on a big move, okay? So you're not gonna trade with $100. You're actually gonna trade with way bigger amounts. So you're gonna put that $100 at your brokers, and your broker will tell you, well, we'll let you trade with 100,000. will loan you the rest of the money. So even if the currencies move a bit, you'll make way more money. But if it moves against you, you'll lose way more money. But that's what we call leverage, and we're talking about that in another lecture. I just want to comfort you in knowing that, when we're talking about big amounts of money like that, even though you will be trading big amounts of money, you're not putting it up. You're putting a fraction of it up, and we'll talk about that later. But this is going to be your standard lot, 100,000. Then some brokers started introducing mini lots, right? So mini lots, so you trade with smaller amounts. So it's 10, and this has been there for a long time, mini lots, 10,000 units of the base currency. But something more recent was the micro lot, okay? And the micro lot was just 1,000 units, which is extremely small, okay? So one lot is going to be this, 0.1 lot is going to be this, which is the mini lot, 0.01 lot is going to be the micro lot, which is going to be this. So we've looked at what pips are, and we've looked at what a lot is. Now, the next thing that you need to learn is pip value. Pip value is composed of pips and lots, so that's why we had to view these two first to be able to calculate the pip value. Now, pip value calculation is basically you saying, well, how much am I going to make in dollars, in money, for each pip movement that this currency makes. So every pip that it moves up or down, how much am I winning or losing? For example, let's say you have USD CAD. So this is the current price of USD CAD. Now, how much would it cost us to get one lot of this? Well, we know that one lot, okay, one lot here, is going to be 100,000 of the base currency, which is USD, times 1.35251 is going to give you 135,251 Canadian dollars. That's the contract value. That's how much it's going to cost us to get this one lot, right? And don't worry, we're going to talk about leverage in the next lecture, so you'll know that it's not going to cost you that much. Now, the pip value is the profit that you're going to make for each one pip movement. So what's one pip? We know that a pip is 1, 2, 3, 4 decimal places after the zero, so it's 1 here, right? So that's a 1 pip movement. So we want to know what happens if the price goes to 6 here instead of 5, okay? So instead of having 5, it goes to 6, or it goes down to 4. It moves by 1 pip. Well, let's see, what would be the contract value if the price went up by 1 pip? So to 1.35261. Well, the contract value would be 100,000 US times 1.35261, which gives us $135,261. Now, the pip value, so in this case, if this currency moves up by 1 pip, how much money would we have made? Well, we would have made, 135,261, the price at which we're selling, minus the price at which we bought at, 135,251, we would make $10, okay? $10 in Canadian. Now, if you want to know how much you made in the base currency in USD, well, all you would have to do is do the $10 divided by the exchange rate, which in this case, it would have given you 739 in US, okay? Now, when we're talking about pip value, it is usually calculated, well, it is calculated in quote currency. So when we're talking about pip value, you're usually talking about quote currency. But if you want to look at it in the other currency, you can do that. The value of the pip is going to be based on how many lots, right? So in this case, I calculated that you bought 1 lot. But imagine you didn't buy 1 lot and you bought 0.1 lot, right? Because you didn't want to spend 100,000 US, you wanted to spend 10,000 US, right? Well, in this case, what would have been your pip value? It would have been 10 times less this. So it would have been $1, your pip value. If you wanted to trade 0.01 lots, okay, so 100th of a lot, meaning you just wanted to trade in 1,000 increments, well, what would have been your pip value? Well, 10 times less than this one, so it would have been 10 cents, right? That would have been your pip value. So the pip value is going to depend really on the lots, the size of the lot that you're using. Are you trading 0.1 lot, 1 lot, 10 lots, 100 lots, 2 lots, 2.5 lots? It depends, right? But based on the lot that you're using, you're going to be able to know that, okay, well, each pip that this currency moves, I'm making $200 or I'm making 75 cents. So that way, when you're going to be looking at prices, and I'm going to pull something up here. Let's say you're looking at USD CAD, and again, we'll look over charting soon. You'll know that, okay, well, look, if I'm doing 1 lot, I'm making $10 per pip. You know that if the price goes, let's say, from here all the way up to, or let's say from where it's at now, 33408, and it goes to, I don't know, let's say 628. Well, you can calculate that the difference between those two prices is 22 pips. So you'll be able to say, okay, well, 22 pips times, $10 per pip, I'm making $220 if it goes from here to here. And because of this, you'll be able to, calculate how much profits you can make, or how much you're willing to lose. And we'll be able to use that for other calculations as well that we're going to get to later on. But this is the calculation. Now, a way to do this is very easy. There's a simple formula to calculate this, and the pip value, you can conclude that it would be the lots, how many lots you're using, times 10. So that's the simple version of the calculation. So if you're trading whatever you're trading, you can say, well, okay, if I'm trading 1 lot, well, 1 lot times $10 is going to give me $10. That's the pip value. If you're trading, like we said here, 0.1 lots, well, you would do 0.1 times $10, and then this gives you $1, right? The same calculation that we came earlier with. If you were trading, 0.01 lots, you do that times 10, and that gives you the 10 cents we calculated earlier here, right? So this is a simplification of the formula, so you can just use that if you want. But later on, I will be giving you an Excel sheet that does all of these calculations for you. But I still want you to learn them. I still want you in the beginning to use a calculator and to test it out. Now we're just looking over all these, terms, but we're going to be using all of them at one point later on in the course. So don't be overwhelmed. And I'll see you guys in the next lecture. Leverage is going to be another term that you want to be familiar with, because trading Forex cannot be done without leverage. Okay? So what leverage is funds that your broker loans you. Okay? So your broker, whoever you're transacting through, is going to loan you these funds so you're able to transact with more money. Why? Because in the foreign exchange market, as you've seen, movements are very small. So for you to make any type of considerable profit or even loss, you have to trade big, okay? And unless you have big capital, then it's not going to be worth it, which we've talked about. You're not going to buy for $100 worth and expect to make money. It won't work. So you need to borrow huge funds from your broker, trade with that, so your trades have bigger impact. So brokers can loan you huge amounts, okay? They can loan you up to 1,000 times your money, which is crazy, right? You don't get that in stocks. You don't get that in other markets. Just in the FX world that you have such high leverage. Now, it's not because you have access to 1,000 times your money that you should get that. Different brokers are going to give you different types of leverage, but we'll talk about more of that later. For now, what you need to understand is when your broker tells you, and when we go to look at brokers, you'll see that each broker has a different leverage number that they'll give you. This is how you read it. When you see leverage 1-to-1, that means you're not getting anything extra. Okay? It's your own capital, basically, which no Forex broker gives you that, okay? What would 1-to-1 mean? It means that your margin requirement, margin is how much money you have to put in to get the amount that you're gonna trade. Let's say you want to trade for $100,000. Well, if the margin is 20%, that means you have to put up $20,000 of that $100,000. So it's the margin required to trade all that capital. In this case, the margin requirement is going to be 100% because you're not getting any help. So if you wanted to buy 1 lot, you would need to put up $100,000, right? Depending what the base currency is. Now, if you get 2-to-1 leverage, what this means is that we're giving you 1 extra for each one that you're putting in, okay? In this case, your margin requirement is going to be 50%. So you need to put 50% of the money, the broker puts the other 50%. And in this case, buying 1 lot would require you to put in $50,000 because they're putting in the other $50,000. Now, if you were trading stocks, the maximum leverage they would give you would be somewhere around here. So with stocks, if you have something that's very risky, they don't give you any leverage. It's 1-to-1. If it's, okay, safe, they give you 2-to-1 leverage. Now, if it's very, very, very safe, they'll give you like somewhere around the 3-to-1 leverage, okay? But that's it. It doesn't go over that. But you see here that with FX, the leverage is crazy that you can get. So then if you can get 10-to-1 leverage, then you only need to put 10% of the margin requirement, meaning for a $100,000 position, you only have to put in 10K. 50-to-1, which any broker in FX is going to give you at least that. Well, you only have to put 2%. So you can literally put $2,000 in and trade $100,000 worth of a position, which is huge, okay? You can get 100-to-1, which in this case you put 1% of the capital, requiring you to put $1,000 for a $100,000 lot. You can get 200-to-1, which a lot of brokers have that as well. Now you have some crazy brokers who give you like crazy leverages, which we'll talk more about that later. But in this case, you can get 1,000-to-1, which it's not because you can get it that you should use it. When we talk about risk management, we'll talk about this specifically. But in this case, you will only have to put 0.1% and the broker will give you the other 99.9% to buy that position. So for a $100,000 position, you only need to put $100 in. And for this to make sense, imagine this. I'll go here on Trading View real quick. Let's bring it up here. Here we go. And if we were looking at the same currency here, USD CAD, if you put up $100 and use 1,000-to-1 leverage, meaning you get $100,000 so you can buy 1 lot, we've already talked that 1 lot in this case would make you $10 per pip. So every pip that this moves, right, moves by a pip, you make $10. So in this case, if you would have, let's say, bought it here at 13350 and this currency goes up to 1340, okay, then you would have made 50 pips. So with $100, you buy 1 lot, it goes up 50 pips. Well, you make 50 times 10, $500. But imagine you buy it and it goes down. All it would have to do is go down by 10 pips, right? Because if it goes down 10 pips, then you lost 10 pips times 10, which is $100, which is what you put into your broker initially, and you've lost 100% of your money, just like that. So if you lose all your money like that, your broker shuts down your account, you lost your $100, they get back the money they loaned you, the 99.9%, they take it back, right? So they're not really taking any risk on you. It's just you're taking the risk, and this we'll cover in the risk management section. But it's just to understand that leverage is a double-edged sword. A lot of newbies that come into the market, they're like, okay, well, I can get this much leverage. I want this broker because it gives me the most leverage. Well, you shouldn't use this much leverage. That's too high. You'll lose all your money. So you have to do proper risk management to know what type of leverage you want to use. But more importantly, you shouldn't choose your broker based on the leverage, because you'll see that brokers who give you crazy leverages, they might not have your best interest at heart because it's too much risk. And this we'll cover more in the risk management course, but just to understand that you can get loaned huge amounts of money to trade your positions, but you have to be very careful because leverage is a double-edged sword. Short selling. So you've probably heard of that term before. What exactly is it? Short selling is something that you do when you borrow an asset that you don't have because you want to sell it in the open market because you expect its price to go down in value and you think you'll be able to buy it back at a lower price and then give it back to its owner. So the way it works, okay, is basically, let's say you have a product here. If you think it's gonna go up, well, what you do is you just buy it, and when it goes up, you just sell it and you make money. But what if you thought it was gonna go down? Well, how can you sell it if you don't previously have it? Well, you can borrow it from somebody, right? So let's say you can borrow this thing from somebody and sell it on the open market. And when we do that, we call that shorting, right? And when it goes down in value, as you expect, well, you can buy it back. And when you buy it back, then you can give it back to its owner. And you would have made the proceeds in between. For example, if you sold this here at 136, and then it went down to 131, and you buy it again, you give it back to its owner, you just made the difference. You made the 5 cents difference. Let's have a simpler example here. Okay. Let's say you know that there is the iPhone 11 that's coming out in a few weeks. And you know that because the new iPhone is coming out, the price of the old iPhones is going to drop in value. Now you don't have an iPhone, but you think you can make money because of this drop in value in the old iPhones. So what you do is you go to your friend's house, you know he has an iPhone 10, and he's sleeping. You talk to their family, you talk to their dad, you're like, hey, you know what? Can I borrow this iPhone 10? Okay? And I promise I'm going to give it back to you tomorrow. Okay, I'll bring it back tomorrow. You know, your son's not gonna know about it. So you get the iPhone 10. You go online, you go to, I don't know, an online selling store, eBay or something, and you sell it there. And the price for iPhone 10s is, I don't know, $700. Okay, so you make $700. Now the next day, in the morning early, the iPhone 11 comes out. Now the iPhone 11 comes out, and it's the price of the iPhone 11, and it doesn't matter, it's like 14, they're super expensive now anyways, 1400. Now because the iPhone 11 came out, the iPhone 10, its price dropped in value, and now the going price on eBay and all these other stores are 500. So you go back there and you buy this iPhone at $500. So initially you received $700, okay, when you sold it, and now you're buying another one, the exact same thing, for $500, right? So in the end, you have $200, and you still have the same iPhone, right? You still have the same iPhone. So what you do is you bring back the iPhone to your friend's house, and you give him back the iPhone. Now your friend's dad takes the iPhone, puts it back in his son's pocket. Your friend never knew that you borrowed it at all, and you made $200 in profit. That's how shorting works. You borrow funds from your broker, so you don't actually borrow these things from your friends, you borrow it from the broker, right? And you're able to transact and bet that something is going to go down or go up, even though you don't even have that thing, because you're borrowing it from your broker, and you're able to generate money because of that. So if we look at something, again, let's just bring back our example here on USD CAD. If you bought this at, let's say here, this price, which is 1.28, when you're buying this currency, what you're actually expecting is that the base currency, in this case USD, is going to gain in value. It's going to be stronger. And because it's going to be stronger, well, it will be able to give you more Canadian dollars in the future. It's going to be worth more Canadian. So you either think that the US dollar is going to strengthen, or that the Canadian dollar is going to weaken. Because if the Canadian dollar weakens, well, you would need more Canadian dollars to give you the same $1 in US. Or if the US strengthens, you're still going to need more Canadian dollars to get you $1 US. So that's when you're buying it. Now, when you're shorting it, because you can buy here and sell here, and this is, let's say, 136, this is 128, so that's 8 cents difference, which is 800 pips. It's ridiculously huge, but that would be if you're buying it. Now, if you're shorting it, well, then you're actually selling the USD and buying the CAD. So you're expecting the USD to lose in value, okay? So your base currency to lose in value, to not be as strong as it was. And because of that, it will get you back less Canadian dollars. Or you can think of it as you think that the Canadian dollar will be stronger. And because it'll be stronger, it'll get you a US dollar is going to be worth less Canadian dollars, right? Because the Canadian dollar is stronger, so that should require less of it to get $1 of US. All of this is going to make sense as you trade and you practice, but it's just an understanding of this would be buying and selling. But then if you want to bet that it's going to drop in value, you would have to short here and then buy back at a lower price. And that's really what shorting